To understand what moves stock prices, we should start with supply and demand. Let's pretend we're starting a company and looking for investors to help get us started. Our company will start with 1 share. Let's go find an investor. To do that, we should probably put together a story about our newly minted company. Right now it's just an idea, so we'll call it the Idea Company. We have no product yet, but we can talk about the future and what it could look like. Let's see if we can pique anyone's interest. As it turns out, we do. We find a very nice lady who decides to buy 50% of the Idea Company for $500 after hearing our story. So we take out our 1 share, tear it in half, and give her one of the halves. In return, she gives us $500. Now our company is worth $1,000. Wondering how we got to $1,000? In the stock market, a company's value is called the market cap. The market cap is simply the total number of shares multiplied by the price of each share. Right now, there are 2 shares, and because the last sale was for $500, the company market cap is $1,000. 2 shares times $500 each. Did you notice how this company is just an idea right now? That happens in real life too. There are many stocks in the market that are simply idea companies. They're real companies, but so early in their development that they haven't sold or even made a product yet. The idea that the value of stocks is tied to actual companies couldn't be farther from the truth. This lady bought half of our company because she thought it might be worth something in the future. That is how the market values companies. They look at what the company could be worth in a few years, not what it's worth today. Let's get back to our investor. As it turns out, she sold half of her half to someone else for $2,500. That's a quarter of the company. How much is our half worth now? Remember, we add up all the pieces or shares to make up the market cap. So if a quarter of the company is worth $2,500, then the whole company is now worth $10,000. And our half, well, that's worth $5,000. Wow. So what happens if the guy who just bought a quarter of our company wants to sell but can't find a buyer at $2,500? I feel a crash coming. Is he forced to take a lower offer? Well, he would be, but as luck has it, he finds a new trader who thinks the Idea Company is overvalued. That trader makes a deal to borrow the shares for a small interest rate. The original trader agrees to lend the shares since he's okay holding them for a while, and he'll get paid to do it. How did this just happen? In the market, this is called short selling. The trader who borrows stock pays a small interest rate to the owner or lender of the original stock. The borrower is hoping to sell shares now while the price is high, but buy them back later at a lower price. If they're successful, the profit will be the difference between what they can sell them for now and what they're able to buy them back for in the future. Less any interest, of course. But what happens if the price doesn't go down? Well, let's see. Apparently, the trader who borrowed those shares went out into the market and sold them for even more. The shares continue to get passed around, and interest starts to grow. At a certain point, there are even rumors that the Idea Company may be included in a large ETF. This means there's going to be a lot of shares that will need to be bought really soon. Since there's a limited supply of shares, that means the increased demand will push the price per share even higher. A frenzy ensues, and everyone is trying to get their hands on the Idea Company shares before the big ETF starts buying them all up. As more and more people bid up the pieces of this small pie, eventually the trader who borrowed a quarter of the Idea Company now realizes he's in big trouble. The market is currently valuing that quarter of the company at $25,000. Maybe we should buy ourselves something nice, because our half is now worth $50,000. The trader who borrowed the shares starts to panic. While we're out shopping for something nice, he goes to his analyst friend and tells him the story of the Idea Company and how the price is now skyrocketed, but they haven't sold any products. And the owners, well, they're out spending all their new money before they've even started working on anything. He goes on to explain that the Idea Company is trading at such an astronomical value strictly because people think it's going to be included in some ETF. Well, his analyst friend decides that's not right and publishes an article about the company stating it has no real product, no real revenue, and will surely never be worth what the market is paying for today, much less ever included in any ETF. Dang. The market catches wind of this and everyone starts selling their shares as fast as possible. But there are no more buyers left. With no buyers, sellers are forced to drop their asking prices, and the stock price, it plummets. By the time we got back, the trader who borrowed all those shares was able to buy them back, pay off his debt with interest for a grand total of $100. Yeah, he bought a quarter of the company for $100. There was no demand left, and the price just dropped. Thankfully, we didn't find anything expensive to buy, or we'd be in real trouble. While this may seem like an extreme example, I assure you, it is not. This happens every day in the market. So how can you protect yourself from getting stuck with an idea company selling at an unreasonable price? Do your homework. But what's the homework? For traders, our homework is called analysis. There are different types of analysis, but don't worry, none of them are really complicated. What is important is to understand the different types and which you should be using in different situations. This brings us to the next and first real step in your journey to becoming a trader: understanding different types of analysis.